From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for April 4th, 2025. Looking at the calendar, this weekend the Bucks are down south in Miami and New Orleans, and the Brewers are in town for the weekend with the Cincinnati Reds. And now for something a little different. Actually, it's a lot different. It's the 4th annual 80s prom at the Cooperage. That means big hair with enough hairspray to put a new hole in the ozone. But Michael Jackson will be there along with new cover bands, and you'll have a disc jockey spinning records from the 80s. Sounds like a hoot. All right, let's kick off April with a fascinating blurb. Bill Gates was told by Apple founder Steve Jobs that Bill should drop acid to help make Microsoft products more interesting. Kind of a backhanded compliment. Anyway, Bill declined the advice. In spite of all that, it seems like he's done pretty well for himself. And speaking of drugs, man, they're everywhere. Here's a new term we're going to have to get used to. It's a narco-sub. It's a semi or completely submersible boat that's used to deliver cocaine across the oceans. Recently, the Mexican Navy seized the narco-sub 150 miles off the coast of Acapulco. It was carrying 8,000 pounds of cocaine, worth more than $54 million. And the U.S. Coast Guard caught one with 1,200 pounds of cocaine on board. The U.S. commander said, "Wherever there's an ocean, you've got more narco subs than tuna." But tuna still tastes better. A 16-year-old babysitter in Kansas got quite a surprise after a child she was watching complained, "There's a monster under my bed." So to prove to the child that there was nothing there, she looked under the bed, only to find a creepy stalker hiding there. The sitter wasn't having any of that and got right into it with him, and the pervert got right into it with the pervert and called the cops. The creep is now hiding under his bunk in jail. On the podcast today, we have Art Rothschild, Kendall Bauer, birthday boy Joel Dresang, and wrapping up the week, here's Kyle Tetting.
Well, thank you, Max, for a few minutes of humor before we dive into some of, I think, the more pain from markets this week. The NASDAQ down 10% this week, down 1,735 points to close on Friday at 15,588. The S&P 500 down 9.1%. That's 507 points, closing at 5074. And the Dow Jones Industrial Average, after dropping 2,231 points on Friday, lost 3,269 for the week. That's down 7.9% to close at 38,315. For the year, NASDAQ now down 19.2, the S&P down 13.5, and Dow Jones Industrial Average down 9.7%. You know, Kendall, I think you and I spent a little bit of time earlier today just talking through some of what we've seen in the last couple of days, and I think it's easy sometimes to sound tone deaf when we're talking through, well, what's the right approach in this environment? It's easy to skip past some of kind of the acknowledgement of what we've gone through, and I think it's important first and foremost for us to talk about what we've actually seen so far and the real reactions that we may be feeling towards it.
Yeah, I think we'd be doing a disservice to our clients, to investors alike, to not acknowledge how difficult the last 2 days have been. It's not fun. It's not fun to watch your account balances shrink, to watch performance on your portfolio drop as quickly as it may have had the last few days. Understand our job is to be the voice of reason in these times, and it is to explain all the things that we talk about ad nauseum on this podcast about the approach we take, why we take it. But I don't think we should by any means minimize what we've seen the last couple of days, because it's been nasty.
Yeah, I think that's fair. And I think sometimes we take a lighter tone or a softer approach to some of the hard news. And I think we were given a reminder this week that there are certain things out there that can sometimes take markets down more quickly than we're used to, more quickly than we're comfortable with. Art, I know as you kind of have had conversations, not just in this period of decline, but certainly in others you've seen in your career, as one of our more tenured investors, one of our more tenured advisors, what kind of lessons should we be taking away from this? What kind of conversations do you tend to come back to when we're dealing with periods where, again, in the span of just a couple of days, we've given a lot of the gains we'd seen recently back?
Yeah, I would say be careful. Most individuals should be careful not to overreact to whatever happens. That having been said, I want to come back and talk about the week just a little bit. You mentioned 2 days, okay, and that's actually what it was. The first 3 days of this week, we were actually making money. We were better off, a few days in than we were as at the end of what was the worst quarter since 2022. That being said, the other thing that we do, because we manage money, as you just suggested, very methodically, okay, and we take pains to not overdo risk in client portfolios. So when we look back at the performance of the first quarter for most of our clients, they did significantly better than the markets, than the S&P 500, losing probably less than 1%, if that, for the most part. And then all of a sudden, when the president announces his new, tariff plan, the markets got creamed, a couple days in a row, and there's no telling when this might end. So coming back to answer your question, I think different sell-offs feel differently. This particular sell-off is pretty extreme, it's pretty quick, and the real question, we were talking about this earlier, is what's going to cause it to change? Back to Kendall's point about our reaction to it, I'm going to suggest, as you just asked, we shouldn't overreact, as I suggested a second ago. But if you do feel pain, definitely you should call your advisor and get counseling. That's what we're really good at. And if you feel like you're taking too much risk, even though maybe before you didn't, that's because you just reached a pain point. And so from my past experience, I was here in, we had the tech wreck in 2001 and 2002, the Great Recession, you were here as well. That was painful, and it was drawn out. That took about 6 months before that unwinded and we started to improve. This is a pretty precipitous decline. We don't know when it's going to end. 2020, the pandemic sell-off was very quick. Anybody who got out at the bottom made a mistake because it came back so quickly. This doesn't feel like that. We had 2022, we talked about that earlier, when, not on the show, but before the show, the market sold off in anticipation of a recession that never happened. The Fed was simply doing their job. This time around, we're talking about major structural changes in global trade. And I think it's reasonable to assume that could result in a weaker economy going forward, lower corporate profits, lower consumer spending. And so I think investors should get educated, call us if they need help, and just don't overdo it and don't overreact. Don't bail out. Timing doesn't work. But reducing equity exposure, I think, is a good strategy for those who are concerned.
Yeah, I think it's never too late to make a move. And Art, to your point, this is why we're here. We're here to pick up the phone during these times, during these markets. And, to the surprise of some of the folks that I spoke to today, because we do things the way we do, we take that balanced approach. They were holding up, through yesterday, a heck of a lot better than the overall market. So you may be surprised to hear how well you're doing, but even just having somebody on the other side of the line to talk to you about, hey, don't forget the last 12 to 18 months, we've been trimming from parts of the market that had gotten overpriced, that had done very well in anticipation of something like this happening. We had about an 18-month bull market from October of 2023 up until February. So when we get on stretches like that, it's in our nature to typically be setting cash needs aside, pulling back equities, because it's pretty consistent throughout market history that we see these types of pullbacks, whether it's a correction, whether it's a bigger drawdown like a bear market, about every 12 to 18 months. And so by all means, reach out to your advisor. We're here to talk you through these types of situations and remind you, hey, this is the type of market that we plan for in advance. And the balanced approach we take is certainly holding up pretty darn good right now.
Kendall, what you're talking about is something that Kyle wrote about on our website, and it's in the newsletter that goes out today. And Kyle, you referred to it as a prepared response. We don't know when things like this are going to happen, and you can see how the markets in totality have responded, but the prepared response by balanced investors took something like this into account, not knowing when it would happen.
I think the challenge is that there is this desire to take action. That we feel as just humans that when you're watching things move in a direction that makes you uncomfortable, that you have to do something about it. And it's a perfectly natural response. It gets back to that fight or flight, right? This idea that when threatened by something, the human response is to do something about it. And I think the challenge is in remembering that what we did about it, we did 3 months ago, 6 months ago, a year ago, when we were taking risk off the table. It isn't because we knew this was the thing that was going to take markets down. Yeah, I would have told you a month ago that if you imposed these kinds of tariffs, that it was likely to have this kind of impact. We didn't know precisely what they were going to be, but we knew eventually it was going to be something if it wasn't this. And so it's that game plan that you have long before it becomes necessary, I think, that sets you up for how do you navigate the environment. Of course, I think the challenge is that we don't always know what the right plan is when everything's going well. That sometimes, and Art and Kendall, I think you both hit on this, sometimes you don't know until you've faced the threat how you're actually going to feel when you see it. Not everybody knows, am I a fighter or am I a flighter? Am I the one that's going to stick around and fight it out, or am I the one that needs to run from this? And I think sometimes it is these environments that tell us, here's who I am and here's how I should invest as a result. Most importantly, and Kendall, I think this is was your point especially, is it's why we're here, right? To help navigate. And I'll tell you, I am more grateful for the conversations we have with clients in markets like this than at any other time. First and foremost, because I normally start every conversation with, how are you doing? And when clients call in to talk to me when the market's down, the conversation always starts with them asking me how I'm doing. And again, it's what we're here for. We're used to this. It doesn't mean it doesn't hurt for us as well. It doesn't mean we're not there right alongside. But I think it does remind us of kind of the human element of this business and why it's so important in an era in which you could just as easily go have a robot manage your portfolio, go have artificial intelligence tell you, here's the right allocation, to have somebody occasionally to talk to about this kind of stuff.
Kyle, what's funny is the first 2 phone calls I got today from clients, they asked me that very same thing. The first thing was, well, how are you doing? So that's great. I think just to go back to something you mentioned earlier, the human response is to want to potentially take action. But I think it's important to remember that oftentimes doing nothing, which is still an action to take, you have to make that decision to do nothing, can be one of the better things to do when things are zipping around left and right. I also do think we should inject some positivity, and maybe Art dive in. But what we're seeing now that we didn't see in 2022, are bonds rallying in the midst of the sell-off the last couple of days and to begin the year.
Yeah, the other thing that's very positive is looking back at how well we've done to this point. And so I don't think it's inappropriate for any investor to look back and say, wow, look at all the money I have made still to this point over the past 3 years, 5 years, 10 years, 20 years. And if, as Kyle just indicated, you feel like, I don't like losing that much money, when things go down or if things get worse, then taking a little bit of action, moving 10%, 5%, 15%, 20% even out of equities to fixed income. Sure, you're not going to make as much going forward, but you're going to feel better because in response to what you just said, Kendall, you will have taken action. So not taking action is an action. Taking an excessive amount of action could be detrimental. Timing doesn't work. But taking a little bit of an action to take a little bit off the table can at times make you feel a lot better about what's going on, because then if things get worse, you can always say, oh, at least I did something so I didn't lose more. And if things get better, you can say, well, I'm still in the game, and I'm going to do just fine over time, and I've done just fine to this point in time.
I think to piggyback on that, depending on your time horizon and risk profile, and maybe it's too early, and I'll never forget Bob once told me don't rush to catch a falling knife, but moving money into stocks if you have a longer time horizon, looking at this as a buying opportunity if you have cash on the sideline. Again, it all depends on each individual, but that's another course of taking action that could certainly have positive impact 3, 5, 10 years from now.
I think long term, some of the smartest, best investors are the ones that tend to think like contrarians, that buy when there's blood in the streets, that sell when everything seems to be going okay, because they recognize that the deals come from all the people that are responding emotionally rather than rationally. And I think that is the hardest part of being an investor is, we've had colleagues on the podcast for years talk about, the reason you put up with the volatility is for the opportunity that stocks present, but it doesn't always feel like it in the midst of the sell-off. And I think that's the part we'll always come back to. I talk about in the newsletter article going out this afternoon that some of the best days for stock returns come amid some of the worst. And it's the reason why that market timing piece doesn't work. You don't have to be right once that you sold when things were expensive. You have to be right twice in that you bought back when things were cheaper. And I think it's far easier to say, hey, I'm a long-term investor. I'm getting a better deal today than I got 2 days ago. Yeah, it might be a better deal a week from now, a month from now, a year from now. But 5 or 10 years from now, I'm going to look pretty smart having bought stocks at a time when I got them on sale. Joel, a fairly quiet week from an economic perspective, given everything that was overshadowed. Anything in particular stand out to you as far as economic data this week?
The jobs report came out today, and it looked pretty good. The U.S. added more jobs than expected in March, and it was the 51st month in a row that the U.S. has added jobs. It's been going great guns. I saw one of the analysts I was reading said this is a day where bad news doesn't matter. I mean, where good news doesn't matter. Any news, right? But that was relatively good news. But it's that's looking at March, and we don't know yet what, if any, effect the tariffs and the repercussions from those tariffs will have on employers hiring and people getting jobs and feeling confident about spending money, which is what grows our economy. We had a couple of other announcements this week on from the Institute for Supply Management, interviewing supply managers in the manufacturing sector, and they went into contraction. Their gauge went into contraction for the first time after 2 months up, but those were the first 2 months up in 2 years. So there was a little bit of a hesitancy there. The same thing with the service sector. It was still in expansion territory, but it was the weakest month in the 9 months that they've had in a row of expansion. But both of those surveys showed that supply managers in March were getting skittish about tariffs. They were hearing about the tariffs. They didn't know at the point of the surveys, how big the tariffs would be. But they were worried, and some were already saying that it would affect their industries. Half of the service sector managers said that they were pessimistic, and it was because of what they would expect would happen with the tariffs.
I think just a kind of quick summary of what we've seen and where I think we're headed. Clearly, the last couple of days of market activity driven very much by emotional response to the unknown, very much driven by technical selling, pressures in the market that you get when you have some overpriced stocks, but more importantly that you get when you don't have clarity on where we're headed. And I think as we move through now a couple of days where the market's going to be closed, certainly the news cycle doesn't stop. And as we get more information on how the world is going to respond to tariffs, how the U.S. is going to maybe kind of manage those expectations going forward, I think it becomes a much clearer conversation on now fundamental shift. And that's the part that as investors we have to be much more cognizant of. It's the part that the economic data becomes so important for, and why it's so critical that we pay attention to how is the economy responding to this new normal. What are purchasing managers, what are businesses doing to respond to changing prices, to the impacts of tariffs? And that to me is the piece that then starts to influence what should we as investors do going forward. Are we going to see the pullback in earnings that usually comes with economic slowing? Or is the earnings growth that we had hoped for more or less in line with what we expect now to see this year? And I think those transitions are ultimately what will tell us more about where is this headed, what should we as investors do going forward. I think no shortage of anecdotes from car dealers or from appliance manufacturers or from any other number of sources that, yeah, they're definitely worried about how their business is going to adapt to this new environment. But until we have some clarity on the when, what, why of how this all shakes out, I think it's going to be some more emotional response rather than true fundamental shift. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.